Hey everyone, welcome to a live Q&A. I haven't done one of these in quite a while. I've been compiling some of your questions through the community tab, so thank you for that. It's about time I actually go through those questions. If you have any more questions that come up while I'm going through these, definitely throw them in the chat and I'd be happy to answer them. And sorry for the late start. I said I was going to be starting this at 8, but it ended up being 8:15 since I realized that all of my equipment was still in my torn up basement, which if you've watched my previous couple videos, you'll know that that has taken up quite a bit of my time and a lot of my money recently, and that my basement flooded and been going through all the renovation work there to get rid of the water damage and all that fun stuff. Anyways, let's go ahead and dive into some of these questions. If you're a subscriber, you should get these occasionally where I put out community posts, and they look something like this. This is from a month ago, actually, and I asked for people to comment below to ask questions. So I guess I'll just start shelling through some of these and see what we can get going. Investing with Tom, a a fellow YouTuber over on Punch Card Investing, which I'll actually be doing shortly after this stream. If you're interested in that, so be sure to stay tuned for that. This will be, I suppose, a warm up show before I get into Punch Card Investing. That is at 9:30 Central Time, and yeah, wherever that is, wherever you're from, that's when it goes on for you. 9:30 Central Time, whatever that is, everywhere else. Anyways. Investing with Tom says, would you consider building an acquirer's multiple formula portfolio alongside your magic formula portfolio? This is something I have considered doing. For those of you who don't know, I do have a monthly magic formula series where I've put together a magic formula portfolio to see kind of what that looks like in real time, what sort of results we would expect to get with that. So yeah, I definitely have considered doing acquirers multiple, since that's kind of the direct response to magic formula. It is it basically removes one of the main factors of magic formula, and that's return on invested capital, and it just looks at earnings yield, so the relative cheapness of the company, and apparently it outperforms magic formula, at least in back tests. So I would imagine it probably outperform in the future too, but though who knows, you never know what will really happen. But I'm definitely considering doing that in the long term, having an acquirers multiple experiment alongside the magic formula portfolio to see what happens there, because that would be interesting. J Money, does your lawyer background give you any kind of advantage when it comes to investing? Well, I don't know if advantage is the right word, but certainly it gives me I do have, I don't want to say, how do I say this without coming off as like arrogant? I don't want to say I have a more sophisticated perspective, because it's just one lens of many that you could have. I have like the legal side in mind, the liability side, kind of what's my recourse. I'm thinking of that a lot of the time because of my legal background. But it's not like that's any more valuable than a financial sort of background where you're all about the numbers. So it's not as a one is inherently better than the other. It's different. And I'm trying to always add new perspectives. So I don't want to just be a one trick pony. All I know is the liability side. So like in undergrad, I wasn't just studying law, reading and writing, but I was doing a good bit of finance as well. So I really learned a lot about financial analysis and how to, when it comes to real estate, for example, how do you actually calculate the numbers on a rental property? That's super important too. Just as important, if not more important, than the actual legal side of knowing how the legal process works, what's your recourse if something happens, insurance, liability, all that great stuff. So there's lots of different facets of investing, and always trying to expand your perspective, I think, is super important. In fact, when I went to law school, I wasn't really intending to be an attorney. I thought that I could be this sort of JD advantaged investor where I wouldn't even be an attorney. I would just be able to go help some investment firm as an analyst or something in the meantime, and then I would invest in my own deals. That was kind of my thinking. But then my skill set was really more fit probably for law, as opposed to being something like an analyst. I certainly tried to become an analyst, like a real estate analyst, but no one wanted to touch me because they saw I was going to law, and they thought, oh, you're just going to become an attorney. And sure enough, I was kind of don't want to say I was boxed in, but it just made it clear that that probably was the best option for me. And so far, I'm really happy with it because I ended up in a great opportunity in commercial real estate law. So I'm still within the game, which is really, that was the most important part. Wherever my career ended up going, I wanted it to be in real estate so that when I do invest, I have that perspective to go off of. But also, I was already building my network in real estate. So when it comes to building a career, your network is key too. That's investing. That's your job career too. Like everything's important. It's always important to have a network in any of those things. And the more power to me, I think, if I can have my work networks coincide very closely with my investing networks too. So you get some synergy there. That's kind of a LinkedIn buzzword, synergy. So that's kind of my thoughts on that. A long-winded way to answer that question. I suppose it does give me an advantage in some respects, in the same way that someone with a different perspective would have a different sort of advantage. If you had more of a math background, you'd probably be better suited to run the numbers really well, really fast, and you have that sort of analytical mind. If you have a more creative background, art, drawing, whatever it is, you might be more inclined to do something like the planning or architectural route or something like that. There's so many different areas in, I'm really kind of focusing on real estate, but in investing in general, there's lots of different little niches that you can carve out, and staying within that circle of competency is very important, but also expanding that competency all the time, whether that be through leveraging other people and resources or through just actually learning it yourself. I think that's always super important. Good question. Thank you, Jay Money. Karan Granani, another member of Punch Card Investing, and he asked, would you have a second YouTube channel to show off your chef skills? Go check out my one of my many April Fool's videos from this year. I did do a souffle recipe. I do like to cook. I think for now I'll probably keep that to April 1st. Every year I'll do like a recipe or something. That would be kind of fun. I don't think, as much as fun as it would be to launch a cooking channel, first off, I don't even know if I'm probably not that talented anyways to actually warrant having a bunch of content for that, but I'd probably get good really fast if I was making content all the time. But yeah, that is something I would love to do long term. I'd say something having to do with regular cooking content, but it would be for fun. It wouldn't be like super serious. At least I would think. Yes, I do like to cook, and I'm always trying to get better there too, because that's fun. When you make money moves, do you listen to Bodak Yellow? No. Maybe I should. PJF asks, how about the topic of real estate investing and inflation? Just talk about the topic. Well, at least with real estate, you get access to, in the US at least, you get access to such great financing terms. You get fixed rate debt against real estate, which should appreciate over time with inflation, or it's not really appreciating. It's more that the dollar is devaluing against the real estate. So your value is preserved in the real estate. Meanwhile, you get to pay back that debt with cheaper dollars, and that is super valuable. And that's kind of where you can get a spread on your money, is that you have the inflation eating away at the value of the debt, whereas the value of the property is remaining the same, but in dollar terms, it's going up. So you have that sort of delta there, and that is super advantageous. And basically everyone else is paying for it who doesn't have fixed rate debt or owns real estate. They're paying that through inflation. So I'm not going to call it fair by any means. It's not. If central banks throughout the world weren't printing money like there was no tomorrow, and also subsidizing the mortgages that allow people like me to buy homes with fixed rate interest rates for 30 years at ridiculously low rates, you'd have a lot cheaper real estate, that's for sure, at least in dollar terms. But it would come with a whole host of different issues. It would be a very different landscape is really what I'm getting at. Hope that satisfies the real estate and investing and inflation sort of niche there. It is very advantageous if you own real estate and fixed rate debt while we have lots of inflation. Not always, because if it comes with a massive interest rate hike, then you're going to lose property value potentially. But still, you'd probably expect, if you have fixed rate debt and you're buying a property that you can actually pay for with the rent, you should be pretty insulated against inflation if you buy right, which is always the caveat with real estate. You got to buy right. Jonathan Davis, is your wife involved in your house hacking and real estate investment decisions? Well, of course. She's involved in many decisions. I do kind of manage most of the financial decisions. However, everything kind of goes into a pool for us. We have like a couple. We have like our personal accounts where a small portion of all of our income will get split off into our personal accounts, and that's kind of our like spend on whatever you want. Uh, that's our spend it on whatever you want sort of money accounts. And that's how we kind of appease ourselves in that way, I suppose. And then the rest all goes into a pool, and most of that goes towards investments or debt pay down, something that will add to our net worth over the long term. That is the goal with the vast majority of our income right now, and really for hopefully forever. I don't like saying hopefully. That is our goal to have it that way for forever. As for house hacking, we did have a roommate for a while at our old place before we moved to this place. We don't really plan on doing that unless we feel like we absolutely need to, because it is a burden, and we do want to start a family at some point in the coming years. And um, sure, we could get back with house hacking again, but if it causes stress to one or both of us, then it's not really worth it. Even if we're saving a few extra $100 or even an extra $1,000 a month. Is it really worth your happiness, your level of frustration being that much higher? Probably not. You got to weigh things carefully. Is really all I'm getting at. We talk about stuff like this all the time. So yeah, we're always communicating, and it helps when I'm constantly tracking things for the YouTube channel that we always have tabs on kind of where we're at as a team, and it's been great. So I mean, yes, to answer the question, she's involved in some things, in the things where I'd say it affects her life in a more direct way, like with house hacking, but with something like stocks or kind of the money outside of the house, that's typically stuff that I manage, just because it kind of takes a certain level of interest in it, and she's not very interested in it. She is off doing her audiology things, trying to become an audiologist, an ear doctor, and that's where that she spends the vast majority of her days working on that. Whereas I'm spending way more of my time in real estate, so I'm already around the game in my career, so it just, circle of competency, coming back to that. It kind of goes to that. Um, but communication is key, just as a word of advice to any soon to be weds or newlyweds, even though I guess I'm only 2 years into the game. But it's really been great. Having family as like a long term goal, or wanting to provide for my family as a long term goal, is it's super motivating. I don't know how different my goals would be if I didn't have my future kids in mind, if I didn't have my wife in mind. That it's super motivating to have the people you love and care for as sort of your I don't want to say it's motivating to have motivators, but they are the motivators, and that's super powerful for trying to move it with your financial goals, but really just all goals in general. When you have something you can strive for that's bigger than yourself, in this case, my family, you could kind of tie that back to myself, I suppose. That's super motivating. But when you don't have those sort of external goals, it can be hard to get going. So, yeah, that's what I'll say there. And then magic and games. How much would a woodchuck chuck if a woodchuck could chuck wood? It's a great question. I think he asked this a couple months ago. I don't know how to answer it. Anyways, that's it for that round of questions. On to the next one. We had a lot. This was a week ago. I asked the same things, asking for Q&A. If you guys have any in the chat, definitely let me know. Oh, I see my wife has entered the chat. Thanks, Emily. So I guess she's in on the live stream. So to your question earlier, she's probably in the living room right now below me. So that's funny. Investing with Frank, also a punch card investing member. In the long term, 20 to 30 years plus. How would you ideally want your portfolio allocation between the stock market, real estate, and any other assets to be split? So portfolio allocation in general. It's a good question. The umbrella answer is it depends, but that's a cop out. I don't want to get too far into that. I would imagine 20 to 30 years, that's a long time. A lot could change. Not only in the sort of economic and fiscal environment, but also my competencies. They could change a lot too. 20 to 30 years is a long time. If I was to do it based on kind of my current competencies, if I wasn't going to be super dynamic long term, if I was just kind of stay in this sort of wheelhouse I'm in right now, it'd probably be majority real estate. Well, I mean, it definitely will be a majority real estate, I'd say, if you don't factor in debt. If we're looking at real estate equity versus just real estate property value, the property value is going to be probably very, very high compared to everything else because I'm buying it with other people's money, the bank's money or whoever's money, whatever lender, because it's just so cheap relative to the asset, at least in my view. And if you can you can use it in very powerful ways. Got to use debt with it with a lot of care, of course, but um, I would imagine just from a dollar amount, most of it's going to be in real estate, like over 50%, majority for sure. If we're just talking about equity, probably be a little bit less. I don't know. It'll kind of depend. If, for example, if 30 years from now I'm running a REIT or something like that, it's going to be lots of real estate. I'm not sure if that's really a goal of mine, but I do want to run something like a housing nonprofit. And I mean, you wouldn't have like a share in that, but that's probably where a lot of my money will be going towards something like that, a real estate foundation or even a real estate company for profit. So I'd imagine a lot would be there, and it would kind of depend on what sort of business I'm running. If I'm running something like that, or if I'm not, then it might be split a little bit more evenly. At least where I envision myself being 30 years from now, I envision having a lot more money than now. You can call me arrogant for that, but that's the perspective I have. I want to have way more money than I do now because I'm constantly investing everything now. It'll have time to compound. I'm trying to stick to things that I'm decent at so that I can make more money with that. Focusing on making new income with my career, I'm always going towards that goal. So if 30 years from now I'm making a lot more money than before, or that is my net worth is way higher than it is now, which it should be as long as I keep taking the right steps, then it might be a little bit more diverse to be a little bit more defensive. It might be more broadly spread between a lot more passive index fund type investments, perhaps more defensive sort of things like that aren't going to have massive outsized returns because you're just investing in the market, but you're going to have a little less volatility, just living off the dividends, whatever it is. So that's kind of a grayish area answer, but I'd say if I'm super mega ultra wealthy and it's not all in one company, then it would be very diverse, kind of a Ray Dalio type. Just put the money everywhere and maybe make some bets on things that you feel good about, outsized bets compared to everything else. But otherwise, the backbone of the portfolio is very diversified, and that's once you get beyond my real estate portfolio, because I don't plan on selling pretty much anything I buy unless I'm rolling it into another property with something like a 1031 exchange, just assuming that is not eliminated. That's a good question, Frank, though. That would be my long-winded answer there. If I have some sort of real estate company, it's probably going to be most of my net worth will probably be there, and it should be because that would be my competency at that point, or where I can make the highest returns, risk-adjusted returns, I should say. But if I don't have something like that, it might be a little bit more diversely split between stock market and real estate. We'll see where cryptocurrencies fit in at that point. I don't imagine that would be a massive portion of my portfolio, assuming that market really stabilizes somewhere, because it seems like we're trying to find a price point for all these cryptocurrencies, and if they become like a staple like any other currency, then there's probably not going to be a lot of return to make there. And I don't trade currencies as it is, like dollar to yen or something like that. I think if that market were to stabilize, it'd probably look something like that. Maybe, I don't know. That's assuming that actually ends up being a thing. I'm trying to think of other asset classes as well. Art or stuff like that, NFTs. I don't really picture that being a bunch. I do like some cars here and there. It is my goal to get a few cars. I really want like a classic Corvette Stingray, like a 1969 Stingray. That would be super cool. But yeah, but that wouldn't be that wouldn't move the needle that much in my net worth. I'm not like a super car enthusiast, but it would depend. It'd be something like that. Yeah. All right. Moving on. Investing with Tom. Once again, what's the most concentrated you're comfortable going on an individual stock? So that's kind of a similar sort of question to Frank talking about allocation. Um, so it depends on the stock. I hate saying it depends again, but if it's, I probably wouldn't want one stock unless I actually own the company, like I'm running it or I have like real control over it. I wouldn't want it to become the majority of my portfolio. Most likely, I don't like having that sort of third party risk associated with someone else running all of my investment. If that was going to be like half my portfolio, um, so less than half of my portfolio, but that's already a massive portion. Uh, and just going off like a feeling, probably like a 20% bet because that seems to be where the highest. That's about as high as I've been going, anyways. For example, like Pershing Square is about 20% of my net worth. Uh, Equity Commonwealth is like 15% of my net worth. Turtle Beach is like 7 or 8% of my net worth, and that should be about the highest I've gone. And I have a couple index funds like in retirement accounts that are about the same sort of weighting. So yeah, that's I guess it kind of naturally is fit into that about 20% allocation. Um, but if I was like running my own real estate business like more aggressively like a fund, I might be putting a lot more money into that, but I'm controlling it at that point. So it's a little bit different. And if you count that as a stock, I'd probably have a lot more than 50% of my net worth going into that company if I was really betting heavily on it. At least at this stage when my net worth is not particularly massive. If I had tons of money, then yeah, I'd have more of a kind of a safety net portfolio that's more diversified, kind of like what I was saying earlier. But good question. Tech. I see you're in the chat as well. Um, if you had to pick only one asset class to invest in, what would it be? And you have a second question here. Do you think value investing is dead? One asset class to invest in. Well, I mean, it has to be real estate. The thing about real estate in the U.S. is you're not really investing in the real estate as much as you're investing in the fixed rate debt. That's kind of my perspective on it. It's I'm riding the fixed rate debt as the government rides the dollar down by printing tons of it, and then uh, that makes the real estate comparatively cheap against your fixed rate debt, and then you win, and then you're getting rent meanwhile the whole time. Um, and if I can confidently keep getting deals at what I think is a good price, under market value, or otherwise has a good cash flow yield, then I'm going to do that all day. I'd be fine with getting rid of all stocks if it meant that I could keep buying cash flowing real estate because I should be able to get pretty good returns there long term, especially if I can factor in fixed rate debt. Um, so yeah, I'd have to pick that at least now. That might change in the long term if I find something that maybe a newer sort of asset or some subsection of a market that I come to know really, really well, then maybe that could become my expertise. But for now, definitely real estate. And then your other question: do I think value investing is dead? No, definitely not. It just like any sort of strategy, it will have its good times, it will have its bad times. Value has definitely not had a great decade because um, well, I guess pretty much all stocks have had a great decade. To be clear, it's not like value's been like negative 50%. Just using the very broad value term, just anything that's not tech, basically. That's kind of how it's used in Wall Street. It seems like, um, but value has its days, and when it has its days, they're massive, or maybe not days, but months or years. That's usually where value makes its killing is when everything else is not. So during those periods, that's when you can make a lot with kind of general value stocks. But value investing, as I think of it, which is just buying something for below its intrinsic value, which theoretically is all investing. Like everyone is investing because they think the thing they're buying is worth more than it is, or that it will be worth more than it is. I guess that's kind of more growth sort of oriented. But at that point, you're projecting the growth into the price you're paying it for. So inherently, I think everything is value investing unless you're just buying something purely blindly. But even at that point, your blind intuition is just, hey, I think this is worth what I'm paying for. But you wouldn't buy something if you didn't think it was worth buying, even if that thinking is flawed. So really, I think everything is value investing when you're buying investments, real estate, stocks. You're buying something because you think you're getting a good deal on it. Um, and oftentimes people are getting a bad deal on it, but because they're going off pure emotion and not really anything fundamental. But I mean, what are you going to do? That's human nature. We're very emotional people, and that's the hardest thing you get over in any investing. Uh, like if this were so, I mentioned like my basement flood at the beginning of the beginning of the episode. Um, if this were my first real estate deal, I'd probably be freaking out right now. Even though it's just money. That's the way I keep looking at it. It's just money. It's sticks and bricks. That's real estate. It will be fixed. It'll be some sort of range of money that I'll have to spend on it, and then it will be done and shouldn't bother me for quite some time. That's really what it is. If I was a complete rookie, I'd probably be freaking out, thinking I'm going to go bankrupt. Maybe I wouldn't have had enough reserves or not enough income coming in, and all of a sudden I'd be in trouble. I'd think real estate is terrible. I'd let my emotions get the best of me, and then I would never do it again. That's what you got to avoid with investing. Perhaps it's luck that this didn't happen to me on my first deal. But luck is where opportunity meets preparation. So it's like because I was prepared enough, even though this has been pretty terrible and not fun. I've been able to navigate it, and it's frustrating. I'd like the money back. I'd like that this loss would have not happened, but it did. So I'm gonna just pay my way through it, which is the way to get out of any sort of rut in investing. You just keep investing. Or it's I think it's a lot easier to add more money to the pot than to try and churn the pot and make something happen with it in the short term. That's very hard to do. Just keep going, keep adding that portfolio, and then soon enough, uh, you'll have enough money coming in from the investments, even if they're not great investments. So long as you're not over leveraged, you'll be okay. So that's kind of the perspective I'm going into it with. That was a bit of a tangent on emotion and investing. These are good questions. Let's get one from the chat here real quick, and then I'll go back to this list. I've got my punch card brew, even though I'm drinking water, because that's all I drink. I do not drink. Punch card brew, as designed by Punch Card's very own Karan Granati, which you can get in. If you guys come on over at 9:30 Central Time over to Punch Card Investing, we have those mugs mugs and glasses for sale in the description over on Karan's shop. So check those out. He sent that one to me complimentary, so thank you, Karan. All right, chat. Let's see. High tech, good to see you. Well, it looks like StreamYard's changed the way they pop up questions. It is going as good as it can go, I suppose. All things considered, with the basement flooding and all that fun stuff. Otherwise, good. I am healthy. My wife is healthy. We're safe. We are secure, and yeah, that's all you can really ask for. Price and Pride asks, does your family help with your real estate pursuits, finding deals, fixing things, money, etc.? Yes and no. So, interestingly, my first real estate agent that we used was my wife's cousin. Uh, she's really more like an aunt, but technically a cousin. But that's kind of the relationship that her and my wife have. And I got to know her well, and I like her a lot. And she was actually my first real estate agent. And she helped connect me with a couple of people. But otherwise, I think most of my connections in real estate have been through school. I met a ton of people down at the University of Illinois interested in real estate investing, real estate as a career. And I've continued to build on that network from there. So that's where a lot of my sort of help, I guess is the word you're going for, has come from those connections through school. And my family did subsidize me heavily through undergrad. So I suppose in that way, they allowed me to build that network more comfortably. So that was certainly a layer of help. Otherwise, my family's not, at least my side of the family, is not really into real estate. I don't want to say I'm a pioneer, but as far as I know, I'm the only one of the people I'm close with, at least, that's doing real estate, that's really interested in it, whether that be as a career or just for investing. I'm trying to think if there's any agents laying around that I'm not realizing. But yeah, of my close family, no one's really in real estate. But I think the the biggest way they helped me, of course, was just, raising me in a safe place, um, giving me good values, or at least preventing me from going into bad values. However that works with parenting, I'll find out soon enough when I'm a parent. um, that's the biggest value they provided to me. And you can't really repay people for that because it's so valuable. Um, but like from a direct real estate perspective, I'm not yet. Um, we do have some family members that can help us as lenders. We do have like a loan out from a family member that we use to help pay for my wife's school. So that's kind of like the furthest it's gone. Though we've had some who've entertained the idea of lending us money for real estate. And we'll see if that happens in the future. If I need some liquidity, that could be an interesting way to do it, sort of like a private money, hard money sort of thing. But that's about as far as it would go, or I think would go. Um, so yeah, good question though. Let me go back to our list and I'll get back to the chat in just a second. What does retirement mean to you? What comes after you and your wife hit your goals? That's a deep one. Retirement to me. So when I say retire, I don't mean like go sit on the beach all day, though that would be pretty great. I'd spend a lot more time on the beach probably, but or at least we live somewhere because, well, we do live on a beach technically, or sort of on a beach by Lake Michigan, but that's cold half the year, so I don't really count that. Granted, it is nicer than not having any beach at all. Retirement to me, I use retirement interchangeably with financial freedom, in that you could stop working for someone else if you wanted to on like immediately. Um, Even though retire technically means like you retire to something, like you not give up, but you fall back into something. You retire from the action that you were doing. That's really technically what it means. But to me, I use it as like financial independence, financial freedom. The income from my investments or my businesses could pay for my lifestyle, and then I wouldn't need to go work for someone else to pay for that lifestyle. And that's super liberating, or at least I imagine it will be when I get to that point. Even just making these incremental steps, it gives you a level of comfort, but not it's not like content, but because I still want to keep getting more, and I still want to keep improving our position and trying to make a difference, and eventually building a charity and a business. Being able to pursue those things without sort of the financial threat of, oh, what if I get fired, or oh, what if I want to take half a year off? Having that sort of lifted would be, I think I'd become a much not a, I'd probably be a lot better in my career, but also better in just everything else, because you don't have that sort of stress. It's not a very productive stress, I think. As long as your goals are good outside of that. For some people, people need that stress of, okay, if I don't work hard, I'm going to lose my job, and therefore I won't do anything, and therefore I'm going to do something. That's good, I suppose. That's kind of what capitalism goes for. It's incentivized, not altruism, but it incentivizes people to be productive, whether they like it or not. If you're not productive, then I mean, you're not going to eat pretty much, which is cruel, but that's kind of what it's going for. If you can remove that sort of factor, but your goals are still strong enough to keep pulling you towards being productive, or being helpful to society in some way, then that, I think, is the ultimate position, because then you are only doing something because you want to do it, not because you feel obliged to in a negative way, in that like you'll starve or something like that. But you feel like you were doing this not because someone is telling you to. Maybe you're into some higher power or something like that. They're telling you whatever the motivation is. It's internal. It's not coming from your boss or someone else. So that's where I think the distinction is when it comes to financial freedom, retirement. It's having that freedom to do what it is you really want to do. Maybe that is the same job you were doing, but again, you have that weight lifted off, in that if an emergency pops up, you don't feel like you have to choose between you choose your job over going to see some once in a lifetime thing with someone you love. Like that would be unfortunate. And that happens to people all the time, and it will always happen to people, because reaching financial freedom is hard. It takes a long time. For some people, it's easy because they get lucky, but it is hard. for the vast majority of people, it's a long journey, but if you're disciplined with it, it is very achievable. It just takes a lot of time and some discipline, significant amount of discipline, I'd say, for most people. Um, but getting back to this question, what comes after you and your wife hit your goals? I kind of mentioned the charity sort of goal or perspective. I definitely would love to do something with a housing nonprofit or something like that. Um, I don't know if I want to start like a real estate fund or who knows. We'll see how my stock picking is over the next 5 to 10 years. Maybe we could start some sort of not a hedge fund, but some sort of fund. Maybe even a family office type deal, friends and family sort of thing. That would be a lot of fun though. I think ultimately the biggest focus will be the way I'm kind of picturing it is once I'm financially free or like very financially free, like I have a lot of money coming into where I could fund something like a charity more directly with my own money. Um, I would want to, I think what I would do is I'd have some sort of charity or foundation. And then within that foundation would maybe be something like a for profit housing entity or maybe a nonprofit, but having maybe for profit sort of big goal oriented companies within them. So there's still that for profit motive for the people within that company, but it's at least the foundation, the nonprofit that has its overarching charitable goal, it still has a share in that business. So the profits that that business makes go into the foundation. And I think that would be probably the best way to align the incentives. Um, just thinking very broad scale there. So in that way, I'd have businesses within the foundation that are for profit, but the profit doesn't like go into someone's pockets at the end. At least not the foundation's pockets. But if someone else owns shares in that business, then that could. But the foundation could own a large share of those for-profit businesses or something like that. Um, that's something I'd love to build long term. Something like that, without getting too into the weeds. Some sort of charity doing ALS research. That's something near and dear to my heart. Um, my wife is definitely interested in hearing loss, seeing as though she's an audiologist. So something with hearing aids, cochlear implants, that sort of stuff, and providing that to people in need, or just otherwise making the cost of those products cheaper. That would be fantastic. Um, there's lots of great goals out there. You could pick tons of issues that could use solving. You can make businesses out of them. You could make charities out of them. Make both out of them. So lots of things to go for. But that's kind of like my high level what I'm thinking. We'll see how things change in 5 to 10 years because by then we'll definitely have kids and that'll be a big focus. Well, especially while they're young and take the most amount of effort. Um, that'll be my chief focus once we start having kids in the next handful of years. Um, so yeah, great question. All right, let's keep going. Hot wax. um, how do you source new investing ideas? Do you have any great book recommendations? Anything, investing mindset, etc. Anything investing or anything in general? Let's see. I source new investing ideas. I mean, YouTube is a great source, actually, especially my buddies investing with Tom, investing with Frank, Ryan Granati, and Brad Kellner. I follow them closely because I mean we have our joint venture over on Punch Card Investing. They have a lot of great ideas, and I've used them a lot. They kind of compile a lot of the ideas from a lot of great investors, but then they have their own ideas as well and their own 2 cents. And we also have like our own little chat that we throw investing news around in all the time, and that's separate from our Discord we have over on Punch Card Investing. But things we're thinking about doing videos on, or news that we're going to do a video on, or something like that. That's been super valuable. Just learning about how they think about investments and how they're evaluating risk, and it's just helpful to bounce ideas off of them. So that's one big way. I've actually had a couple YouTube subscribers reach out with real estate deals, um, some of which are very interesting, and like I'd be close to pulling the trigger on them if things look good. So that could be a huge sort of catalyst for deals in the future, and that would be great if I could basically run deals out of my YouTube subscriber pool. That'd be fantastic. And then also meet cool people that way. I've already met a few great people over on the Punch Card crew. Outside of them, the YouTube community is pretty awesome. Not only for investment ideas, but networking, and then you get ideas from there. So that's really the biggest way I do. And then just paying attention to your news feed wherever you get that. Um, like I think I have my like Google feed that I get on my phone occasionally will throw some interesting news on my holdings or holdings I've looked up recently. It'll automatically sort of throw it on me because of cookies and data, so it knows what I like looking at. So that's a good way to keep up as well. Um, and then also to that, I follow like kind of business news, local and national. Here in Chicago, we have a publication called Cranes, which has a lot of good real estate content. So that's how I kind of keep up on some of the local market things. But there's all sorts of things you can look at. That's kind of YouTube being probably my primary one at this point because I'm in the game so deep now. I just want to pay attention to what's going on, and that's throwing off some good ideas. Now, as for book recommendations, I always recommend the Elon Musk bio by Ashley Vance. That is a fantastic book because he's such a weird dude, and his story is crazy. And just I always love reading about great individuals, mostly because like, we all know they're great for some reason, but or for whatever reason it is, whoever that person is. But for example, reading Henry Ford's bio or the Rockefeller bio by Chernow, um, uh, the Musk bio by Ashley Vance. There are plenty of other great people out there. These are just the ones off the top of my head. But what's interesting about them is most of them had some sort of struggle or some sort of deep character flaw, and learning from those flaws or weird things that they do, um, that that's there's a lot of value there. Like, sure, you see that, like, okay, the possibility that they can do this thing, or and therefore maybe you could do it too if you put the right amount of effort towards it, the right amount of focus towards it. But also, they have these vices to pay attention to, and how do you kind of get over that, or something like that. Um, so I really love kind of great person bios. And it doesn't have to be in the business world. That just happens to be where I kind of lean towards. Just stuff like that is really, really great. So another kind of a more action plan book, Set for Life by Scott Trench, or really, I've read a few of the Bigger Pockets books. That they're like a real estate forum. Those are very good too. Set for Life is a great one if you're like a young person coming into or out of college, early to mid 20s. I think it's a fantastic book for that. If you just have not much idea where to start, but it's kind of with your personal finances in general, but also it goes over house hacking in big detail, and being able to buy out a piece of real estate, rent out rooms, rent out extra units, and subsidize your housing costs in a big way. So that's a really great book too, Set for Life by Scott Trench. I have a book list that I posted a while back. That might have been back in March or April of last year. So check that out. I think if you look up top 10 books on my channel, you'll be able to find it. But I have a whole list there. The 10x rule by Grant Cardone, for all of his flaws too. That's just a great kind of like a guy screaming at you to do more the whole time. You just need kind of a kick in the pants. That's a pretty good one too. If you just need like an extra jolt. Haven't read or listened to that one in a while. But yeah, one more from the list, and we'll go back to the chat. Chris here says, any further research on FRPH or HIFS? What is that one? HIFS. Oh, this sounds familiar. I'm not sure what this is. Did we talk about that on Punch Card? Maybe we did. I think you said he did. Maybe someone else on the Punch Card team was looking into it. So FRPH, that's the real estate company that Brad Kellner introduced over on Punch Card Investing. This is one I still need to do research on it. I've been meaning to, but I've been so swamped with work. We had this massive transaction that's about to close, and I've been spending the last 2 weeks on it, almost around the clock. In addition to my flooding basement. Closing this, it's like a $15-ish million transaction, and I'm doing a lot of the drafting of documents for it and getting things out, and it's just a lot of moving parts. And I mean that's what attorneying is. It's putting together documents, crossing the I's, dotting the T's, and covering things like that. And it's been a really good learning experience, though, seeing a very high level big deal with multiple locations, multiple moving parts. It's been really good for that. So once I'm done with that in the near future, I should have a little bit more time open up to actually do some research in FRPH, but that is like top of my list right now to do research on. Anyways, all right. I said I'd go back to the chat, so let's go back to the chat. Would I ever start a real estate fund or possibly go private equity? Like I said, yes, I would definitely consider. I haven't committed hard to that either way. It'll kind of depend on our position, what's going on with my family, because that would be a big ordeal. You'd be managing other people's money at that point. Other people wouldn't be giving you their money as a loan. They'd have equity. That's a much different deal, different sort of deal, and a lot of different considerations to make too. How long would I want to do it? Would it be like a 5 or 10 year fund? Lots of considerations to make there too. I definitely would consider it though. And if anything, I think for sure I'll have a nonprofit, which I guess kind of operates like a fund, and except without really an expectation that people get their money back. But you want to manage that money responsibly. So if you count that. Price and Pride says stingrays are pretty cheap these days. That occasionally I do browse, and they are very surprisingly affordable. So yeah, one day I will have one. Just now is not the time. Now's not the time to indulge as much as I'd like to. That'll be my reward for financial independence, I suppose. Another one from Tech. I need your advice, Jack. Well, this channel isn't legal or financial advice, so we're just here to talk about whatever. But it's all up to you to make your own decision. Anyways, what do you got? I'm 19 and my mom wants to help me with real estate investing once I graduate university, but my main focus is in my tech startup and stock portfolio. What should I do? So does your mom have a real estate portfolio, or she wants you to start one? I'm not super sure on what you're going for there, but so you're already at graduate school. Is your graduate degree related to your? Well, I mean, the degree itself doesn't matter. It's what you're learning. I mean, this is a question for you to answer, my man. It's you got your tech startup. I mean, do you think do you think it's a good deal? Do you like doing the work in that startup? Um, then I might focus more of my energy towards that. Real estate, real estate is probably more defensive than a startup if you really think it's going to be a big thing. If you're confident in it, um, so you might want to go on the offense while you're young, especially if you have something going, you enjoy doing it. Just go with whatever. I'd say this: stick to your competency, kind of like what we were talking about earlier. Um, if your competency is within your tech startup, which it kind of sounds like it is based on this very short excerpt, um, seeing as though you say it's your main focus, then that's probably where it is. I wouldn't get distracted with things like real estate. Sure, like I've said it before on the channel, but um, do you really want to focus on making an extra 20% on your money? Or do you want to focus on making, or how should I say this? Do you want to focus on making an extra 20% on your $10,000 invested? Or do you want to focus on making another $50 to $100,000 in income? So it kind of depends on the size of your portfolio there. If your portfolio is already huge, then yeah, it might make sense to go buy some real estate, get some tax write-offs, you get some income thrown off on that money rather than leaving it in cash. But if you don't have a lot of money as is, like unless you're trying to do something to create wealth in real estate, like forcing appreciation, then it seems like the best way for you to create wealth might be that tech startup if you're confident in it again, and it's in something that you're in your competency. So, food for thought. I hope that's helpful in some way. But yeah, that's a good question though. Best of luck in whatever you do. William Brown, what do I think of farmland? My understanding is that like Bill Gates owns like a third of all farmland in the U.S. now, or something crazy. So uh, I like the idea of buying kind of low maintenance, large lots because they're not making more land. Well, I guess you sort of could. You could terraform, but that's very expensive. Uh, so buying land in general is enticing. But the thing about buying, like, I'm kind of getting into raw vacant land, more speculative side. It's you still have ongoing costs, even if there's no building on it. Like you got to pay for taxes. You got to watch out for squatters as well if it's a really huge lot. So it's kind of a different game. Farmland is also a very different game because there's so many different subsidies involved, different sorts. I think there's very different financing. It's kind of its own little industry. Um, And it kind of depends on where you're buying it too. In the US would be very different than somewhere else in the world, I would think. So yeah, I don't know if that really answers the question. I haven't done much digging into it. It's an interesting industry for sure, and it's real estate, so it probably wouldn't be too hard to figure out. Um, but it seems like institutions are probably, or at least large individuals, if you count Bill Gates as as an institution, are probably moving towards that more than they might have had in the past. But you could say that about a lot of a lot of different types of real estate. I wish I had more. Or I'm sorry, I don't have more to say on that, but I don't want to ramble on something I don't know. Oh my goodness, is that the plain bagel, Richard the plain bagel? Wow, good to see you. That's fantastic. Thank you, and likewise. How unexpected. If anyone isn't familiar with the plain bagel, go check him out. He's one of the better finance channels on YouTube. Fantastic stuff on everything, ranging from stocks. He's talked about real estate as well. He's an analyst himself, so lots of great content. If you guys aren't already familiar with him, thanks for dropping by. That is super neat. See, this is what I was talking about earlier, guys. It's uh, you can meet lots of really great people on YouTube, just I guess social media in general. There are a lot of cool opportunities, and you can meet people with similar interests or even different interests, but really useful perspectives and everything. So it's really cool to kind of have that sort of perspective, or have sort of access to these many different perspectives in such an easy way to access with something like YouTube or other types of social media. Man, I'm kind of starstruck right now. Good to see you, Richard the Plain Bagel. Anyways, let's get back into our questions over here. Triton TV, always a faithful commenter, so I appreciate your support all the time. How do you buy into a hot real estate market that you feel is priced high? He's talking about the Denver area, very expensive. It's had a massive run up over the last decade with possibilities of market corrections. I am poised to buy. It's just nerve wracking. Plan is to rent out as many rooms as possible and live in the first house for a year, house hacking, and then saving for a second down payment. Refinance if value goes up and interest goes down, then 1031 tax defer it. Okay, so it's a house hack start and then into something else. That's how I started. Not quite in the appreciating market of Denver, but in Chicago, I bought a condo. It had an extra bedroom. I rented out that bedroom. It basically covered my entire mortgage. I used the savings there to save up for my second property, the one I bought in Indianapolis last year. Now I have two properties. With the money I saved and am now earning through that rental, it wasn't a ton of cash flow, but it's something that adds to the pool. I bought my third place this year, and I think I will buy another place probably in the next 6 months, or maybe even the next couple months, and just kind of get that snowball going. Kind of like you're getting that rinse and repeat. House hacking though is super powerful because you can put so little down, at least in the U.S. I put 5% down in this place because it's owner occupied. I'll turn it into a rental later. I'm not house hacking it, but I could if I wanted to. I put like 10% down on the first one. I could have put less down if I wanted to, but I wanted to have a little bit more cash flow room. So lots of opportunities in house hacking because you can put so little down. It is a super awesome strategy for getting started. If you're interested in real estate, maybe kind of want a training wheels approach, really awesome thing to look into. Highly recommend it for anyone who's interested in real estate at all. House hacking. Buying a place with owner occupied financing, the best interest rates, the best terms, and then offsetting your living costs, renting out rooms or extra units. Super powerful strategy for sure. So that might be the best strategy in a hot market. Because you don't have to put much money on the table. It's really the bank's money at risk. And I don't take that too literally. Like, your money's still at risk and your credit's definitely at risk. So still be very careful. But I think it's probably maybe it's not the best, but probably the easiest to do in a hot market, because you can get access to such great financing that even a bad deal with normal financing or normal investment financing suddenly becomes a decent deal with owner occupied financing at such cheap rates, stretched out over 30 years, just ridiculous terms. So I like it a lot. So yeah, that sounds great to me. So You just got to find a decent deal, which is always the hardest part. Finding a good deal and then access to that financing, put them together, you get some magic. Christian, what's your take on REITs as an investment vehicle instead of buying and managing your own property? It's a very different game. Can I explain the business model behind mortgage REITs? Oh, I can try. My understanding is they buy packages of mortgage-backed securities and then just kind of like any other sort of bond investor, I guess. That's my understanding. I really don't know. I don't want to go any further than that because I'm not too sure on how that model actually works. My understanding, those are just they buy pools of mortgages in some portion of the market, and then that is the cash flow that they get. Just like a bond, you have the coupon on the bond. That's the income. In this case, it's a mortgage, which is sort of like a massive bond on a piece of real estate. But back to REITs as an investment vehicle, I'd say they're very different in that buying and managing your own property brings in so many different advantages and drawbacks. The advantages are, I think, pretty obvious. Control, you can force appreciation yourself, massive tax benefits, access to that financing I was talking about earlier, potentially. You also like have direct possession, so you can kind of do whatever you want. The flexibility is there, which I kind of what I was getting at with forced appreciation. So that's obviously different than a REIT where you're just buying into the real estate company and see what they do long term, because you don't have control over it unless you're a massive shareholder in the REITs, and then effectively you're managing your own property anyways. So REITs offer convenience, easy diversification compared to managing your own sort of empire, because you got to build that up and then find managers for that. The REIT is a nice little neat package. It should be. The company owns the real estate, has management in place, or should. They're maintaining the properties. It's a lot easier to get into real estate if that's what you're looking to do. But again, it's at a pretty steep cost when it comes to potential upside. Most of the time, I'd say. So if you're not interested in managing your own property, I think REITs are a fantastic alternative. But I would not fool yourself into thinking that it's the same or even close to the same, I'd say, as owning your own property because of the massive difference in benefits. But the risk is that you have to know what you're doing. And so if you don't have the competency to invest in real estate yourself, then at that point it's a terrible investment compared to something like a REIT, most likely. So you got to get that knowledge up, as Ty Lopez would say, knowledge. That's my take on that one there. But good question though. S. Lewis says, "How and when were you introduced to value investing?" I'd say, so I got into real estate investing before I got into stocks, and that in that case, I'm looking at what the intrinsic value of the building is, in my opinion, based on the cash flow it could throw off. So it's kind of the sort of approach I use with stocks now. And I guess I was introduced to value investing as like a pure concept, like its own little package, basically around the time of the crash back in 2020. That's when I was really introduced to it. And I was like, wow, this makes a ton of sense. I've been doing this passive index approach the whole time, and that has its merits, has its drawbacks too, which I was started to learn a lot more about. It's like, wait a second, I could be making what kind of returns if I knew what I was doing in picking stocks, and maybe I don't know what I'm doing. So don't take that as a fact. But I was kind of taught this efficient market hypothesis, but it just didn't make sense to me when you had all these guys throughout every decade that were doing great. And maybe that is a survivorship bias, but they all seem to have a very similar approach, which is this kind of value investing approach, because stocks are businesses. So I thought, well, that totally fits my sort of thinking with real estate too. Just apply the same sort of thinking to stocks, use a discounted cash flow analysis, and then bam, you got like a very similar sort of model that I was already using in real estate and is applied to investing. So I guess I was introduced to the sort of philosophy of basic financial analysis, valuation, before I got into actual value investing for stocks in particular. That's my answer to that. It really does go hand in hand with real estate in my mind. How to start investing from Hajar. Start with your competencies. If you don't know, then don't invest in it. if you do some research, get confident what you're investing in. Maybe it's something more passive. Maybe it's something more active, buying your own properties, individually picking stocks. But just start to learn. That's really the best way to do it. maybe while you're learning, you're doing something more passive just to get money in the market, get used to having money kind of out of your hands, moving around, and just kind of watching it do work. Uh, but definitely start with what you're comfortable with, and don't invest money you can't lose, uh, because there's always a chance it'll lose. Even in the quote unquote safest investments, there's always a chance something like that could happen. Um, so be careful. But yeah, keep learning, and probably lean towards the more passive side before you get into more active things, while you're kind of learning about everything having to do with whatever section of the market you're interested in. Follow your interests, I suppose, is another way to do it, to find that competency. All right, two more questions on this list before I get back to the chat, and then I'll have to wrap it up because you got to get on over to Punch Card Investing in about 12 minutes. Will you ever invest in micro small cap companies? I don't know how you define micro small cap, because I have some fairly small cap businesses. It depends on where your cutoff is. I don't know, what is a cutoff for small cap. 300 to 2 million to 2 billion. Equity Commonwealth is like 3 billion. Turtle Beach is like 500 million. So I already have some exposure. So totally open for sure. Often you could get some out. That's often where a lot of the outsized returns are. It's the kind of jumping from 500 million up to 10 billion. That's massive returns. Whereas I think it's a lot harder to go from 10 billion to 100 billion, and that's a 10x return in itself. But like, you got to look at it in percentage terms. It's a lot harder to make a massive thing like super massive than it is from going from, say, medium to pretty big. There's lots of exceptions to that rule, but that's kind of how I look at it. So if you can find a great small cap, it's a great business, and you're feeling good about it, and you can get it at a good price, then you can get some pretty massive returns. You can still get it with large companies. It's just probably a lot more rare because there's just fewer large companies out there. Maybe that's the difference. There's just fewer opportunities in general. So that's my kind of 2 cents there. Crypto ? I do own a tiny bit of crypto. I think it's worth having a little bit of exposure, but I don't know enough about kind of the intricacies of it. I have a pretty decent layman's understanding of just like Bitcoin in general, and somewhat of the blockchain, kind of how it I have a very layman's understanding, more so than like maybe your average person on the street. Comfortable enough to put a little bit of money there, but not comfortable enough to throw a ton of money there. And plus, I think even if I did know more about it, it'd probably still be very speculative, because who knows where this market's going to wind up, because it's dependent on lots of people adopting it, lots of people to really preserve it, I would think, to get to where lots of these bulls in crypto are thinking it will go. You need a lot of things have to happen to get to that point, and maybe they will, maybe they won't. So I'll throw a little bit of money there just to have that exposure, because I do think it is a very interesting sort of sector in general, not just because of like the ridiculous returns. I'm avoiding pumps. I just have a little bit of Ethereum, a little bit of Bitcoin. It's like 1% of my net worth, so not big at all, relatively speaking. And I'll keep adding a little bit of money here and there, but there goes a lamp. but nothing too crazy. All right, back to the chat. Just got a couple questions here, and then we will hop off. Thank you, Tech. Happy to take the time. I want to do these more often, these question and answer sessions, because I do like them a lot, and you guys have great questions. So thank you for participating for sure, and thanks for supporting the channel, of course. Okay, wouldn't be able to do any of this without you, without all you guys, which is it's crazy, man. This platform's so cool. Just social media in general, it's amazing how many people you can reach just starting from nothing. It's really cool. Michael Lynn asks about Equity Commonwealth. I just did a video yesterday, or was it yesterday? Yesterday. Equity Commonwealth, the merger they were going to have with Monmouth Real Estate just fell through. So that throws a wrench in the plans. They thought it looked like they were going to be buying a large industrial REIT, and turns out they're not doing that. So yes, I have been following that. I'm still on board. My thesis from my initial investment hasn't changed. I was buying a large cash value, or my thesis was I was buying a REIT with a ton of cash below what I thought its intrinsic value was, it's back down to about that same price it was when I initially bought in. So like I'm gonna hang on. You still have the great capital allocator and Sam Zelt. Nothing's really fundamentally changed with that initial thesis. Sure, the fundamental changes that the merger is not going through anymore, but that wasn't part of the initial thesis. And that was, yeah, that's what I'll say there. I have been paying attention to it. I have not sold off. I'm actually considering adding more, especially if we get a drop back down below my cost basis. Not that that not that the fact it's my cost basis is important, but that is still kind of around the same target price I was going for anyways. Um, so I'm following that one closely to see what will happen. Again, it's one of my largest holdings, so definitely paying attention. And Michael also shares some thoughts on mortgage REITs. Key part is that the borrowing at short-term rates and investing in long-term rates. So it sounds like swaps and that sort of stuff, or with mortgages, that would explain some of the complications. So it's not as simple as just buying mortgages. It's trading them around is what it sounds like, and swapping risk around. That's what it sounds like to me. Again, I haven't done a ton of research on how mortgage REITs work. Probably should, being in the real estate industry now. Maybe I'll come across one for my job as an attorney. That'll be fun stuff. All right. Any final questions before I wrap up in the next 2 minutes? 'Cause that was great. We're over an hour now, so we got a lot of questions in there. So I'll definitely be doing another one of these. I want to try to do them weekly, maybe bi-weekly. Definitely let me know your guys' thoughts in the comments below if you're watching this after the fact. If you want to see more of these live streams, I'm not sure if I'll have like a set time of the week to do them. Might just do them kind of whenever I can. Because they're relatively easy to put together, and then I could just, I get your guys' great questions and then get going. But I got to get your questions first. I got to collect those and just think to do it. So maybe if we can make a routine out of it, if you guys like that idea, definitely let me know. Otherwise, thanks for stopping by. Thanks again to Richard the Plain Bagel. That was cool to see you here. And anyone else, if you guys have questions for maybe a future episode or just about anything in general, let me know in the comments below. If you like this video, definitely like it, since that would help the channel out a lot. And be sure to subscribe so you don't miss any new videos on everything else or any new live streams. When I go live, you'll get a push notification if you subscribe and hit that bell icon, which be sure to do that. A lot of my subscribers have not hit that bell icon. So if you're here, go ahead and check that. If you haven't hit that bell icon, please do, so that I can make sure that YouTube actually gives you the notifications to my videos. Thank you, Price and Pride. +1 for regular chat. Fantastic. I guess it's settled then. We'll have to do it more regularly because I do like doing this. All right. I got to get going over to Punch Card Investing. So if you guys want to come chat with me even more, head on over there. That'll be with at least 2 others today. I'm not sure if we have we definitely don't have our full 5, but we'll have at least 3, maybe 4 over on Punch Card. So go check that out, Punch Card Investing. Otherwise, until next time, take care.